We are into the second quarter of 2023, and there are a number of interesting things that are occurring in today's real estate market. And what's interesting to me, most interesting, is that the sky didn't fall and the market didn't crash. And there's mounting evidence that the bottom of the market was November of 2022. And since that time, what we have seen are the number of homes sold decreased in year-over-year totals consistently over the last 6 months. So let's peg that on the wall that the number of properties sold is down. And we can also peg on the wall that the interest rate is higher and the inflation is higher. And yet, in Florida markets, especially in the Daytona Beach area, the median sales price continues to go up. And when we look at the numbers from March, which, now that they're in stone and we know what they are, units sold down 28%. 28% is down. And of course, by now, for those that were waiting for the market to drop, they're saying, okay, this must be the month that prices dropped. But when you look at this March compared to last March, the prices were up 3%. It's 6 months in a row. And, the prediction, the forecast from here was we would see it play out just this way. And, some of the comments were like, no, you're wrong. Your crystal ball is cloudy and it's off. Fine. But there's mounting evidence. 6 months in a row of this. Units down. Rates still relatively high. Prices continue to go up. And the forecast is that it continues to be that way. Nothing has changed in the forecast. And as we head into what some might say are the busier markets, busier times of the year, I prefer to say that we're pretty consistent in this market year-round. We spike during these months ahead. There's going to be increased activity, and not for any economic reason, for the natural reasons. Taxes are done for most people, which means they have all their documents done for the year. It's probably the easiest time of year to pre-qualify for a mortgage because the homeowner has done all the work, or the would-be homeowner, for a mortgage application. It's all right there. It's top of mind. They've probably spoken to their financial advisor. They've probably noticed they didn't have a write-off if they don't own a home or renting. That's one reason for increased activity. Another one, coming up at the end of school years. And if you think about what happens every year, people are moving for a school district, or maybe there's a sport being offered in a different school district, or maybe the kids, they're graduating. And there's no need for a 5-bedroom house. Maybe a 3 would work right now. There's a lot of reasons that people would move. So just the fact that the documents are available for pre-qualification, more readily available, and there's movements because of school year, absolutely a good thing. And you also take into account anyone who has some investments. Are they moving them from stocks or something that, some equities that are somewhat volatile right now? Are they moving into real estate? You see the investor activity is increased dramatically this year. Could it be someone that needs to sell a property? Maybe I don't know. They need to recapitalize for new purchase, or maybe they're going into some commercial space of real estate and they're offloading some of the single family homes or apartment buildings. There's a lot of reasons for movement and liquidation in order to recapitalize and move forward. There's absolutely some people that are selling right now just to recapitalize and keeping something, aside, just in case the market does go a little sideways or down. But there is a lot of reasons where there's increased activity this time of year, which to me is going to play into the inventory situation right now. There's been a steady increase in inventory over the last 6 months in the Daytona Beach area, and we'll give you that statistic just to give you some context for Florida. This time last year, there's probably around 950 homes available sometime during the month. This March, over 1,500, close to 1,600. So even more inventory available, which is there for the buyers and investors to have additional choices. So even though the sales numbers are down, the price is holding firm. And with more available choices, I think that you will start to see those numbers begin to tick up and increase forward. Now, will they match last year's numbers? We'll see about that. but I don't know that the number of properties being sold is going to correlate the price. Matter of fact, I think it's not going to. And that's very consistent with what we've been talking about. So now that we are, stacking up this mounting evidence, as we move forward, what is the single biggest concern of homeowners that are looking to move and buy a different home? It's their interest rate, and they're hanging. It's like, man, I've got this 3% interest rate from 4 years ago. I really hate to give it up. Unfortunately, we don't have mortgage interest rate portability where we can take our current interest rate and apply it to a different house. Can't do that. But maybe they got in at 4%, and maybe we're somewhere in the 6s. Survey was taken, and what it asked home buyers that were paused, just delayed. They just stopped looking or stopped trying or just said they're not going to do it now. What would cause that to change? More than 50% of the responses, pushing 60% of the responses, were the interest rates. And what was interesting was the target interest rate for the majority of the people who paused right now was 5.5%. It's a very small movement to go from mid-6s to mid-5s. That could happen 60 or 90 days. Could happen in 30 days. But I think with the Fed meetings right now, it's more likely to head in that direction, late summer. And at some point, there's going to be an inflection point where we see rates go underneath 6%, and it's going to have some renewed activity. And if you think about the cycle, and this is just me thinking out loud here, if increased activity was April, May, June, which were creating the closings that were happening, right to the month of August, at a time when the interest naturally subsides because most people have made their move, the spike has gone to normalcy. August, September is a time where it's a little quieter. Wouldn't it be interesting if that point when the Fed is done making increases in the federal funds rate, would that be a time when mortgages soften and would we hit that inflection point of rates below 6%? August, September, it's a very real thing. And again, it's a prediction, but it's not based on just plucking some numbers from the air and guessing. See, we are getting into that election cycle again, and there's a lot of momentum over that 1 year mark when the whole campaign trail hits. And I've got to believe that there's going to be some urgency to create a situation where things are appearing to be getting better. And the natural time limit comes in that year. Now, if we walk it back to last year, when the rates spiked, it's about a year ago, of the 4 times where rates spiked in history, like they did last year, the first 3, the interest rates had settled back down to where they were at about the 18-month mark. Not so coincidentally, that 18-month mark is going to hit October, November, in that area. So if rates begin to decrease, get below 6, August, September, it falls into that timeline where rates would be about where they were in the 18-month window. So let's throw conspiracy theory out the window and let's just follow the pattern in recorded history. For mortgage rates dropped, it spiked as they did last year. They dropped about 18 months down the road. So there's history and there's data that suggests this is not only possible to happen, it's likely to happen because it's happened the other 3 times. So 3 out of 3 would be likely for this to happen again. And it's, the indicators I see are trending that way. I do believe that the Federal Reserve rate, the federal funds rate is likely to stop going up over the summer and get neutralized, which would signal that there's a possibility of rates starting to slide down. And I believe once they do, that will become likely. So now as we are traveling down this road of what the next 3 to 6 months are going to look like as far as interest rates, and keeping in mind that the vast majority of buyers, well, they felt that they would get back in the market at 5.5%. We likely will see prices hold firm and continue to increase because purchasing power is going to increase when the rates come lower. Funny thing happened along the way to the market crashing. It didn't. And if you think about 2008, when the stock market absolutely tanked, the run-up before that time, 2003 through 2008, I was in the mortgage business back then, about 7 years in that. During that time, if you examine the interest rates during that run-up before 2008 collapse, they ranged between 6 and 7% the entire time. Matter of fact, I do remember purchasing a home during that time, and I was able to get a rate of 5.875. I was in the business. I was watching the rates, and it was almost a feeling of euphoria to get a rate below 6. It felt like a great deal. And, nobody knew that we would artificially push rates down to 3% and some with government policy. But a natural occurrence of events, 5.875, and it felt like a win. And I don't think that that's different than what people are going to experience this year when it gets in at 5.875 and 5.75 and eventually 5.5, which is the inflection point for the majority of buyers that are on hold right now. It's on the horizon. If you were to look back 4 or 5 years, pre-COVID, remember that thing? You might experience the sensation of we're in a buyer's market because of all the things that are mentioned. The market's going to crash, but the inventory level suggests we're nowhere near a balanced market. A balanced market would be 6 months of inventory. And if you take the number of available homes and just divide that by the number of sales, that would give you a predictive of how many months of inventory that you would have. And days on market could play into it, certainly, but if there's 1,500 homes and 400 sold last month, you've got 3, maybe 4 months of inventory. You would need to see, in that scenario, 400 homes sold, about 2,500 homes available to have a balanced market between buyers and sellers to see. So we're not near that. And you'd have to go back more than 5 years to get to that balanced market. It's been a long time since we've had a balanced market. It's been in the seller's favor. And even though it's taking a little longer and there's less homes being sold, the inventory still suggests it's still a seller's market. Now, buyers and sellers can still win in any market. And ultimately, the prices arrived when the buyer feels they got a great price and the seller feels like they got a great price. That's not a balanced market. That's just everybody feeling like they got a great deal. Same as the stock market. And if you think about it, the person buying a stock today thinks they got a great price and it's going up and there's going to be dividends. And the person selling it thinks it's going down and there's going to be no dividends. So someone's going to be wrong. And it's much the same with the real estate piece or anything that, is being bought and sold. But we are quite a ways away from a balanced market between buyers and sellers. And so if you're looking for reasons for the market to crash, I'm sure that you could find them. And I'd wonder if they're based on emotion rather than evidence. But, this whole conversation has been about mounting evidence. And the beat goes on. So we will likely see less sales in April, May, and June than the previous year. We're extremely likely to see the prices continue to increase, and it would be surprising at this point to see prices actually falling because the evidence doesn't suggest that. All right. Hope you guys enjoyed this. I would love to hear your comments on this. This is Ron Wysocarski for the Black Hole of Real Estate.